Okay, welcome back. We're going to start Chapter 3 on fixed income investments. I like to call them the Rodney Dangerfields of the investment world. And we're going to make a case for asset allocation in this chapter. From 1990 through 1999, 90% of all the money invested in equity mutual funds flowed in with very few market declines. 90% of this money invested in equity funds had never experienced even a 10% loss. So a lot of people switched from having a portion of their funds in bond funds to stock funds. And of course, we all know the result of that. When the bear market hit, the stock funds got hit hard. The bond funds increased in value, and you would have been better off if you had a diversified portfolio, which included bonds and stocks. And of course, investment grade fixed securities would include the treasury bills and notes and zero coupon bonds, and also preferred stocks with investment grade of a rating of BBB or higher. And fail-safe principle number 14 states that investment-grade fixed income investments can reduce risk and volatility in an investment portfolio. And recent studies done by Ibbotson show that since January 1990, a portfolio of 60% S&P 500 stocks and 40% bonds was 40% less volatile than a portfolio of 100% S&P 500 stocks. So normally when economic growth slows and we enter a recession, fixed income securities do well as the Federal Reserve lowers interest rates to stimulate economic growth. That was true in this last cycle. We hit a recession, a bear market in stocks, the Fed lowered rates, and the return on fixed income investments in this cycle held true, and that increased in value as the stocks were going down in value. And again, here's a graph of the down years in the S&P versus 5-year Treasury notes. And in every case since 1950 where we had a down year in the S&P, we had a positive return in the Treasury notes. Same holds true for Treasury bills. Okay, and since 1950, 10,000 invested in the S&P grew to $525,000. There were 10 bear markets since 1950, and the S&P index suffered an average decline of over 30%. And of course, in 1973 and 74, there was a crushing bear market where the S&P lost 48% of its value. And just recently, in the 2000 to 2003 bear market, the S&P lost 50% of its value. And here again is a graph of the return on the S&P 500 index if you were just invested in the index itself since 1950. And you can see in the latest bear market there was a lot of volatility and severe losses. And again, here's a graph of splitting your investment funds between stocks and 5-year T-notes. And again, it made almost as much money, but a lot less volatility and a lot less risk. And here's the results of investing just in the S&P. And again, you would have had a $515,000 return for each $10,000 invested in 1950. The percentage of winning years was 72%, but your largest loss, annual loss, was 30%. It had a profit factor of 1.95. Now, this is investing just in the S&P 500 index. Now, let's see what happens if we invested half of our money in 5-year Treasury notes and half in the S&P index since 1950. Profit of $398,000 versus $515,000. So the total profit really isn't that much less by diversifying your portfolio, investing half in bonds. Your percent of winning years goes up to 79%, and more importantly, the largest annual loss goes from 30% to just 13%, and you have a higher profit factor of 3.4 versus 1.9. So this demonstrates that you sacrifice a little bit of profit, but you get a lot less risk by diversifying your portfolio with treasuries. And here's a graph, and what we did is we compared the return on zero coupon bonds versus the NASDAQ composite index. And you can see the zero coupons had a steady return, and the NASDAQ, of course, very volatile, and entered a severe bear market here in October of 2000. Now, fixed income investing can outperform stock investing over sustained periods of time. And we have a graph here that compares Treasury notes, the return on Treasury notes, to the Dow Jones Industrial Average from 1970 through 1982. And you can see over that 12-year period, here's the return on the Dow Jones Industrial Average. It was basically flat for 12 years, whereas your Treasury notes provided a good, steady return over the same period. So again, if you were invested half in Treasury notes, half in the Dow Jones Industrial Average, you would have had a much better return with a lot less risk.